Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Ted Theodore, the Vice Chairman and CIO of TrimTabs. We talk about supply-demand, how it relates to stocks, building a new ETF, as well as their TrimTabs TTAC ETF, ticker symbol TTAC. Tune in for that right after this. Ted, thanks for joining us.
My pleasure.
So, maybe you could give us an overview of this new fund, which just launched in September. Maybe what's the strategy here, sort of a 10,000-foot view, if you will.
Sure. It's an actively managed ETF, which is kind of a corner of the ETF world that hasn't been too populated. There are a few of us out there, but we're active in the sense that we don't have an underlying index that we manage to, so that would distinguish us from, say, smart beta, where there is an underlying index and then it's run passively. Ours is a fund that's run actively. I think the correspondence between us and a smart beta is that we are, as a smart beta fund is, built on quantitative disciplines. So it's a series of factors that we employ. So it'd be like a multi-factor smart beta fund. But again, because we are actively managing it, we don't have an index that we try to mimic or rebalance to quarterly or in most cases annually. Instead, what we do is we have a benchmark that we are trying to outperform. And in this case, the benchmark is the Russell 3000 index, which covers about 98% of all market value in the U.S. economy. The three factors that we use to select the stocks in the portfolio are the free cash flow. So we're looking for high-quality companies. And the reason why it's free cash flow rather than, say, earnings is that, as you're aware, companies have a lot of discretion on how they report earnings, recognize sales, recognize earnings, recognize assets.
Sure, so it's much more difficult to have any sort of financial gimmicks with free cash flow, right?
I think so. You're never perfectly insured against that, but free cash flow comes the closest because it's so hard to hide, what's going on in your bank account.
Yeah.
So it's a much higher standard. That's not to say that it's perfect, but it's a lot better than just relying on. As you know, there's a growing difference between even what the corporations report according to generally accepted accounting principles, GAAP earnings, and then what they call operating earnings, which takes into account things that they don't think belong in the index there for the company. So we're hoping that by looking at cash flow, we get closer to what's really going on in the corporation. So that's a big factor. The second factor is we like companies that have good balance sheets. So we're looking at the ratio of assets to liabilities as another marker for quality. And if you have good, strong cash flow and high quality balance sheet, you're pretty far along to finding good quality companies. And then, because we are shareholders in these companies and we're kind of selfish, we like it when there are fewer shares. So the third factor we look at is share count. Lots of people look at just buybacks. We're a little bit more stringent than that in that we require the actual share count to go down.
Sure, and you guys are calling this float shrink, right? I mean, that's a concept
right,
I think
exactly.
A lot of investors probably aren't too familiar with, but I think it's one that makes a lot of sense when you sort of get down into the details. Maybe you can talk a little bit more about, what float shrink means in a
Sure.
Investing capacity.
Yes. Well, again, because we are shareholders in these companies that are in the portfolio, it's only natural to say, well, we'd like a bigger piece of the pie if that would be possible. And so we call it float shrink in the sense that the float is the number of shares that are standing, and the shrink is, well, we like fewer shares outstanding because that way our piece of the pie is bigger. Now, companies do that in several ways. The most obvious way is that they'll do a buyback program and reduce the number of shares. But there are other corporate financings that can result in fewer shares. Some people just look at the buyback announcements. We go a step further and say, no, we actually want the share count, the number of shares, to go down. That data, unlike the free cash flow data and the balance sheet data, which change quarterly, the share count actually is available daily on lots of financial records, including Bloomberg and so on. And so we can keep track of what actual share count is what's happening to the share count or the float for the company. So, yeah, we like shrinking float because that means we get a bigger piece of that cash flow. We get a bigger representation of a good balance sheet. So those are the three factors that go into the investment process.
Yeah. Do you think it's fair to call this sort of strategy a supply-demand strategy, kind of looking at a reduction in the supply of shares, and all things equal, same level of demand, the price will necessarily have to go up? Would you think that's fair to say?
Yeah, absolutely. And then the added factor, or the other side of the coin, is that these are high quality companies because we've searched for cash flow and we've searched for balance sheets. So increasing demand, shrinking supply for high quality companies. Yeah.
So maybe, if possible, you could give us some examples from some of the current holdings. I know you have an equally weighted product. You got 100 stocks in there. So maybe either talk about some of the holdings, or why did you guys go with an equal weight approach as opposed to one that might tilt towards some of the best performers or anything like that?
Well, we really wanted to get a broad exposure to these three factors, and sometimes there are industry factors that dominate, but they tend to dominate for short periods of time. There's a tendency for the market to favor energy at one point in the cycle, then it'll move on to consumer staples and so on. So we wanted a broad exposure through time, and it's a conservative portfolio in the sense that we didn't want any one particular stock to overwhelm the performance of the portfolio. So it is designed to be exposed broadly to all the sectors. Now, all the sectors aren't represented in the portfolio because sometimes there aren't companies that fit the criteria. For example, the utilities are frequently not represented in the portfolio because of the way their balance sheets work. There's an awful lot of debt in utility companies, and it's harder for them to pass the balance sheet test for us. So what we are trying to do is get exposure to individual companies rather than to sectors. Our experience is that sometimes when the sector data seems to show that there's attraction for that sector based on the fundamental data that you're looking at or the valuation data that you're looking at, it doesn't always play out the way you think, and that's because there is a strong tendency in sectors for the whole sector to work or not work. So there's a strong correlation factor within sectors. So if Intel reports a great earnings report, surprise everybody, and the stock is up 15% the next day, well, managers say, well, I don't want to necessarily chase Intel, but I'll buy Texas Instruments. And so all of a sudden the semiconductors are moving, not necessarily because of their own individual factors, but because of the sector. So we actually don't want to be in that game. We want to be in the game of looking at individual companies. And so we wanted broadly based exposure, and that's what we get. Now, the character of the portfolio today, it does have an underlying tendency. It's mostly geared towards growing companies, as you might expect, but these companies tend to have characteristics that we like. They tend to be in the technology group, in the industrials group, and in the consumer discretionary. Those tend to be overweighted, and I mentioned utilities don't have much exposure in the portfolio. Right now they have none. And the telecommunications group isn't represented, and some of the consumer staples groups don't get represented in the portfolio because they don't pass the criteria that we've set for them.
So do you view TTAC as more of a tactical holding or something that could, sort of be a core holding for some investors out there?
Well, I think the experience is that these characteristics really are a core characteristic. It's a fairly simple idea. You want high-quality companies based on both free cash flow and their balance sheet, and you want companies where your share of the pie is growing. You want the declining share count. And that does work over a long period of time, and that's been our experience. We've had about 5 years experience with this strategy, and it's worked quite well versus the underlying index that we're trying to outperform, which is the Russell 3000 index, a broad-based index.
And I did want to ask you about fees real quick. So you got 59 basis points a year for fees.
Yeah.
And I noticed the previous iteration of this product had 99 basis points in fees. So I was kind of wondering how you guys managed to slash the costs, basically, almost in half.
Well, one of the things is that in the prior format, we were sub-advisors, and in this format, we are operating with our own trust, and so we don't have that extra layer, and so we can keep the costs down.
Okay. And, so you had that previous iteration. How do you get the word out again about this product? I was a big fan of the, of the initial strategy when it first came out. But, I feel like it's got to be tough to sort of start over from square one.
Well, we have a lot of friends. In the previous iteration, we were well known on major platforms, and those are relationships that we have kept up. It is a little bit of a momentum game in the early stages, but we do have a lot of friends out there. We have been getting pretty good media coverage. A lot of people want to know what the encore was because it did make a lot of news when this first happened in the spring, and so we're finding people that are interested in saying, okay, you're back. You're back at a cheaper price. Same idea, same algorithm, same secret sauce. Sounds good. Yeah,
same thing, cheaper price. What's not to like, right?
Yeah.
Exactly. So what's next for TrimTabs? Do you have any other products on the horizon?
Sure. Well, we think the concept of the cash flow and balance sheets and share count is a strong concept, and we know through our research that it applies in a lot of different ways. And the areas that we are looking at are, say, an international version, which would be the same idea, but instead of just U.S. stocks, it would be stocks trading outside the U.S. Internationally. Still large cap, basically, like the fund that we have, but that would be one area. There are areas within the U.S. market that are obvious ways to go, like mid cap. So it does lend itself, and our research shows that it does lend itself to applications. Just the way this, ETF strategists think of the world. Well, now it's time to move from U.S. large to international, or it's time to move from mid-cap to large. So the strategists who do the rotation and the tactical movement would have a family of funds that have the same basic concepts, but would be responsive to whatever research is driving them to move from one sector to another.
To me, it seems like buybacks are really popular with U.S. large cap companies. Do you see a lot of buybacks for international stocks or even the small mid cap market?
We actually do. Yeah, we actually do, Eric. It's a little bit of a surprise because it became such a huge trend in the U.S. There's no question about it. You're absolutely right. But you certainly can find 100 companies internationally that fit that bill. So it's not as widespread, but it's just as potent based on our research.
Okay. All right. Sounds good. Ted, I think this was great. Thanks for joining us, and
thank you.
Best of luck with the TrimTabs TTAC ETF, symbol TTAC.
Thank you so much.
All right, everyone. That was Ted Theodore, the Vice Chairman and CIO of TrimTabs. Their ETF trades under the symbol TTAC, but feel free to check out TrimTabsFunds.com for more information about their float shrink methodology and how this works in ETF form. Well, hope you enjoyed this edition of the Dutram Report. Make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. Until next time, for Zacks.com, I'm Eric Dutram.